What's up, you guys? Zoe here from OneGlanceTrader.com, and in this video I'll be sharing with you an approach on how you can easily double your trading account with the one strategy that I believe is one of the best strategies catered to smaller accounts. Now, don't get me wrong, you can do these on larger accounts because the incremental number doesn't really make any difference, but if you've got a small trading account and you want to grow your account exponentially and quickly, I think this is the video for you. Now, a lot of YouTubers will say, you do this strategy, do that strategy, but don't actually show you implementing the strategy. And the proof is in the pudding with my channel. I've got a separate playlist which I'll share all the details later on in this video of me implementing this strategy today. So I'm currently trading this strategy at the moment, and all the details will be later on in this video. So what we're going to do, we're going to go through the methodology, how it all works, and then I'll share where you can actually see me actually trading this strategy. And if you like the sound of that, all I ask for is that you smash that like button and don't forget to subscribe either. So when it comes to trading, at the end of the day, it's all about A, making money, and B, setting yourself a goal. Now, what is the benchmark? So when you trade, that means you're actively putting in some sort of effort to make a return. Now, I always look at the S&P 500 as the benchmark. So, you know, over the last 20 years, the S&P has returned 7.45% average yearly, or adjusted inflation at 5.3%. So let's go with the 7.5%. Let's round it up there. Is every year I could just park my money into the S&P 500 and get on with my life, and the expected return is annually compounded at 7.5%, which is great. Now, each year's is going to be different. So if we take last year, for example, last year the S&P made 22.74%, and this is why you can't, it's not about time in the market, it's just about putting the money in, giving it a long enough period for the downswings and the upswings. You'll net out at about 7.5% over 20 years. Now, that is if you did zero effort. Now, obviously, if you're trading, like I mentioned, the expectation is you will beat 7.45%. But the reality is that, what's the stat? 95% of traders just don't make money, where they would have been better off trading index funds or the S&P index fund. Therefore, at least then they would have made a return on their money and also saved on their time. Now, this is what my channel is all about. My content is all about is how can we beat the S&P 500 and minimize the time, and B, minimize the risk of doing that. So that is what we need to beat to make this worthwhile for us to do. And I just want to set the expectation of what exactly do we need to be doing to really double our account. So if we put 2 grand in as initial balance, and to get around $4,000, so 100% return, we need to be making 6% a month to be able to double our account. Now that is absolutely insane, because 6% a month is pretty much what the S&P on average delivers in a whole year. So a lot of people forget, especially when they talk about absolute numbers. So I've got $100, I made it into $200. If you actually think about that concept, you're actually doubling, you're getting 100% return on your money here. So, and again, the way I look at these things is a goal is something to strive for, but it's not something necessarily that you actually have to hit. Now, Grant Cardone, for those of you who have read his book, the 10x method, or 10x every single goal that you have, and the main concept of the book is if you 10x your goal but only achieve 5x, it was better than your original goal in the first place. So let's just say you had a goal of getting 20% a year, right? And you get nowhere near that, and you achieve that goal at 20%. You'll feel very, very grateful that you achieved 20% in a year. But what if you, for example, 5x'd it to 100% and you only achieved 50% of your goal? Therefore, you actually made 50% return, which was greater than your original goal of 20%. So even though a lot of people might say 100% returns are unrealistic and all these things, it is possible, and I'm going to show you how it is possible. It has to be under the right market conditions, but if that doesn't happen, would you be happy with 60% return, 50, 40% return? Because at the end of the day, you're still outbidding what if you just invest in the S&P 500 and left it. And again, this is a 20-year average, right? So next year the S&P could be down by 10%, right? So if you stuck your money in today and then it goes down by 10%, you'll be losing money at the moment. So again, this is an average. Some years are good, some years are bad. I just wanted to make that clear of, this isn't another clickbait video. This is trying to be realistic, and now I'm going to show you how you could potentially do this. So the trading strategy, and again I've talked about it a number of times now on this channel, is options trading with credit spreads. Now, when a lot of people think about options trading, they think of it as gambling and selling out the money calls and all these kind of things. But there's two types of options. There's buying options, which is what I put in the realm of gambling and speculating to a certain extent. Then you've got selling options, so being on the side of the seller, or as I like to put it, being the insurer or being the house in the casino, where you've got these quote unquote gamblers putting calls, placing out the money calls, and you as the seller is taking that money because the odds are in your favor. Statistically, people that sell options make money and consistently make money more than people that buy options or buy calls. And let me just get rid of this. Definitely want to restart tomorrow. And this is what credit spreads do. So you can either do a credit spread if you think the stock's going to go down or the underlying asset, or you can do credit spreads where you think a stock's going to go up. Generally, I do put credit spreads where I think a stock's going to go up, and that's the example I'm going to show you now. Mainly because the stock market goes up, right? And you can see that from the S&P 500 stat is, the S&P goes up every on average over the long term. So I've got videos on options trading, and if you're new and all that stuff, that's not what this video is about. There's a playlist down below and in the top right corner somewhere at some point which will go into that. But effectively what you're doing with credit spreads is that you are selling an option, therefore you're gonna bring money in, and then what you're going to do is you're going to buy a lower strike option as protection, right? So you're going to fund that buy option or that buy put by using some of the premium that you collected. So let's just say, for example, I receive $100 by selling an option. I'm going to use 80 of those dollars to buy an option, so therefore I'll be left with a $20 net credit. That's an example of how we can generate money or return, and it's that net credit that builds up over time as you place more trades to then get you to your 100% return. So I'm just going to go through a quick example on Tesla, and Tesla is a stock that I'm long-term bullish on. I've got high conviction in Tesla, that with what Tesla are doing, where the EV market is, and we've only scratched the surface on the EV market, Tesla is going places, right? So I'm long-term bullish on Tesla, and what I've done, if I can actually just try to increase this up slightly, is walk you through this particular example. So the current price of Tesla at the moment is just over $1,000 a share, or 1,031. And as I said before, you need to sell an option and you need to buy an option. So you need to sell an option and then buy a lower strike option. So what in this example, you'll be selling the 945 strike price, and you will receive $40.70. Now, as options or option contracts are in quantities of 100 shares, so you would receive $4,070. Now, that might sound like a lot of money, but not all of that money is going to be yours, because then what you will do is you will then buy the 925 strike or put option as protection, and that will cost you $3,745. But if you minus these two numbers together, you will end up getting a net credit of $3.25 per share. And as we're talking 100 shares, that is $325. Now, what is my risk? How much am I putting up doing this? Your risk is the difference in the width of the two strikes. So 945 minus 925 is $20, and we times that by 100 because we're talking about 100 shares, so that is $2,000. So again, we're using the example as we showed here of a $2,000 account. So you're investing $2,000 in this trade to receive $325. Now if I quickly do my maths on this, 325 divided by 2,000, that gives you a return of 16.25%. And the piece I should have probably made clear at the beginning, when you do options, you have to pick an expiration date. So I'm shooting this video on the 14th of January, and I've selected the 11th of February expiration. So that option expires in 1 month's time. So I'm looking at 4-week options, 3 to 5 week options. And what did I say? I said that gives us a 16.25% return. You've got to remember, we're only looking for 6% monthly, right? And now this option here gives you 16% return. And the reason why it says 19% return as your max profit is because they are dividing your max loss. So if this trade went completely sideways, you wouldn't lose $2,000. You will actually lose 1,675 because you receive $325. So they do 325 divided by the 1675 to give you 19.4% profit. So I don't include that. I look at it as I'm assuming I'm going to lose the whole thing, right? So my return for this trade, my max return is 16% or $325. And you've got to remember, all we need is 6%. So my goal is to actually, when I trade this type of strategy, is to collect 100% of it in the quickest point in time. So that all sounds really good, but what if Tesla tanks to $700 or something? Then, what's the situation? So that could happen. And what it's saying here is on this is just using statistical distribution and statistical analysis that for Tesla to close below your $925, so if Tesla closes by expiration below this number, you lose the whole 1675, right? But you keep your 325, so therefore that's your difference. But if it stays above your short leg or your first leg at 945, you will collect the whole 325 and keep your $2,000 collateral would come back. So what happens if Tesla starts to go down, which it can do, right? Tesla can go down below your 945 strike, because look, it lost 6% in a day, right? And the difference between the current price and your short leg strike, I calculate it's about 8%, right? So if Tesla has another 6%, nearly 7% loss, you're pretty much nearly at your short leg strike. Now, this is the beauty, in my personal opinion, of trading options. You've given yourself a month to be right, for the price to stay above 945, right? So there's two things you could do depending on if and when Tesla starts going down to 945. You can either wait, so if it happens tomorrow, you still got 3 weeks to be right, or 3-4 weeks to be right. If, for example, it's you're 2 weeks into the option and then it starts getting closer to 945, you can do what's called in options is roll your position. Now, I've got videos, and the video I'm going to share, or the playlist I'm going to share with you, will go into that in a bit more detail. But effectively what it does is that it buys you more time to be right. And the beauty of it is not only can you buy yourself more time, most of the time you can actually get paid to buy yourself some more time, right? And again, it might sound complicated if you're brand new to this, but again, the video I'm going to share, or the playlist I'm going to share, will go into this in a bit more detail. And this is how, in my opinion, it's possible to compound very, very quickly. And again, you have to have a long-term conviction on this stock. If you're not 100% bullish on Tesla, it's not the stock for you. And again, the good thing about Tesla is A, I've got this conviction, and B, it's a very volatile stock. And because, as you can see, it's had 7% days, right? Up and down. But that gives us a good premium to be able to generate, 16, 20% returns on each potential trade. You only need this one trade and you've already outperformed the S&P 500. And so in terms of managing this kind of trade, and again, I talk about it a lot more inside the video I'm going to share inside a moment, but I just wanted to explain how things like this become possible with trades like this, right? And again, it's all about doing this, seeing is believing, and putting my money where my mouth is. So I have created a $500 account challenge where the goal is to, I'm not stated I want to double the account, or sometimes I might have said it inside the challenge, I want to double the account. But the goal here is to do a put credit spreads with an expiration of every 3 to 4 weeks and trying to make at least 10% per trade, right? So if you work that out, that's about 10 to 12 trades a year. It's going to be about 120, 130, 130% if it works out. I'm currently I think I've just done my 5th trade. That video will be released next week. However, the playlist is on the screen now, so you can see how the first 4 trades have gone, and I'm trading this strategy live. You can see the dates, taking screenshots of the P&L of all the orders. I'm fully transparent, and I'd go on to talk more about Tesla, what's Tesla doing, and the ebbs and flows, and why I've picked certain strike prices. So in terms of the previous example, this example was a $20, so $2,000 wide strikes. This one I'm doing $5 strikes. That's the minimum for Tesla. So like the 1,000, you sell the 1,000, you buy the 995, for example. Therefore, the difference is $5. And yeah, it's the same concept. I can just make the strikes wider, or I can trade more contracts to get to how much trading collateral I'm willing to risk. So like I said, I'm really strong bullish on this, and again, I'm showing you how to do this step by step. So if you like the sound of this and want to learn more, click the link down below. Playlist is somewhere, and probably end screens on there, and I should see you guys in the $500 account challenge by clicking the video now.